Well, let's start big picture here. Given the economic conditions, you both said, hey, we're investing right now, so the open sign is open, is on. Let's talk a little bit more about that, though. Do you find that you're still having angels who, when they look at their portfolios and see the impact of Wall Street, that they're more hesitant, or they're considering factors that they didn't before? What's the effect of the downturn having on the outlook of the individual investors?
Sure. So actually, one of the things that wasn't mentioned is I am on the executive and screening committees of the Alliance of Angels as well, and I've been doing that for several years. And so, we are still seeing, a lot of good companies coming through. I've participated in over 30, angel deals over the last, 30 companies. Actually, I've probably participated in 100 angel finance deals during the last 10 years. This is the worst I've ever seen it. So, angels right now, with the market still going down, everybody's, worried about, all of their financial situation, and right now they're just not writing checks in general, and so I think we will see the next few months, if not several months, be difficult. There are, when deals, are viewed as attractive, and that's 50% haircut, 70% haircut. I don't know on price. We are seeing some angels, coming into deals, and occasionally newer deals as well. But this is a very difficult time. So, and VCs are mainly triaging their own portfolios, is what we're seeing. So they're still looking. There will be the unusual deal. I mean, again, like good deals, we'll still find investors if it's a good opportunity. But for the majority of deals, it's a very difficult time to be raising money.
That's a good point. I think much like VCs, the Alliance
Rebecca,
of Angels as a group.
Do you mind using the mic just a little?
Yeah. So the Alliance of Angels, as I said, has been doing this for about 10 years, and so we still have 85 deals in the hopper. So what we're finding is that exits are taking longer in this economic environment, and responsible angels, once they've backed a horse, are going in and continuing to fund follow-on rounds of their existing portfolio companies. So there has been a shift towards existing, and again, the horses that you've already bet on. That said, there are a few trends that we're seeing. Convertible debt has all but evaporated in terms of our own organization's interest. There are a couple of reasons for that. It's perceived as not necessarily being an angel-friendly deal structure.
Could you take a step back and explain that to those who are the uninitiated?
All right. So there are a couple ways you can structure financing through a professional angel organization. One is just straight equity. So your investors as a class will own a share of your company. In our group, it's probably anywhere between 20 and 33%. So we're really getting involved at the seed and early stage of companies' development. The other instrument that you consider is known as convertible debt. So it's essentially a bridge or a loan that gets you over a few hurdles until you can actually get a round of institutional, typically venture capital financing, at which point your deal is priced. So in those situations, if your debt is converting into equity over a period of time, if it's 3 or 6 months away and you're already talking to venture capitalists and the deal is all but done, you just need to accomplish a couple of milestones, that can be an attractive way to go. What we've seen, though, over the last couple of years is that these have become bridges to nowhere. These debt rounds are extending into 12 and 18 months, and a couple of concerns have arisen in the last couple of years. One is that even if you price with a 20% discount, meaning you get a little bit more bang for your buck when it converts, if you actually achieve all the milestones that you set out for yourself, the perception is that the class of investors that took the biggest risk in your company doesn't get to participate in the upside. If you do everything you say you're going to do, your company might be worth 4 or 5 times what it is today, 12 or 18 months from now. So that has kind of fallen out of favor, but particularly now, I've noticed on our screening committee, and Geoff, you can comment here, is that there's very little faith that a venture round, to the tune of $4 or $5 million is going to get done anywhere in the near future. So for us, we're seeing, again, preferred equity deals are the ones that are getting funded. And to Todd's point earlier, deals that probably would have commanded a $3 million pre-money valuation even 2 and 3 months ago, we're seeing at $1.5 and $2 million. So it's a non-trivial haircut.
I'm going to take a little bit different approach on the question. We ask entrepreneurs all the time, what keeps you up at night? I'm going to tell you what keeps me up at night right now is whether our members are going to renew their memberships. We're in our third year, and our renewals for July were 100%. August, we were 93%. September, we've been tracking very nicely. And October, we're tracking nicely. So I think we're fine as far as that. I'm getting a little bit of rest. Secondly, you know, I look at, you know, as far as new members coming in. And so as an organization, we're the Costco model as far as that's how we sustain our revenues. And as far as new members, that creates and generates the revenue for us as an organization. In September, we had a record month for new members. In October, we had a few new members. In November, this month, we're having a record month. And the reason why is because people are hearing about Keiretsu Forum and the other angel groups in town, and they're either stuck in the market or they're out of the market. Their real estate holdings are tied up if they're still in their real estate holdings, and they're still looking to place or make their money work for them. Traditionally, in angel investments, it's not a short-term investment. You're looking anywhere from, I'd say, a 3 to 10-year window for a liquidity event. So they're looking at angel investing as an asset class to invest in currently. I just got back from New York. The reason why I went out there is to figure out what's going on nationally with the venture capital and angel investing investments across the country, specifically on the East Coast. The general outlook from this conference that I walked away from the VCs was that they're saying 18 months. And it was across the board, everybody was saying about 18-month window before we start seeing everything start to turn around again. Now, why that's such a concern for myself and Keiretsu Forum and our members is that we typically give the companies a 6-month to 9-month run rate on investments, sometimes on a 12-month on the high side. So we as an organization have to look at, okay, if we're doing a bridge round or a Series A, for example, and we're investing $1 million, $2 million, $3 million per company or whatever the amount is, we have to realize that in 12 months, if the market has not corrected itself, we're going to have to step up and fill those rounds out. So right now I'm in full mode of recruiting for new members, because if we're able to increase the membership to a point where we're actually able to bridge our own rounds, so we'll be able to sustain the companies that are coming through Keiretsu Forum and the other groups in town.